Good afternoon and welcome to this week's weekly education session for the Elite Traders Club on Wednesday the 10th of June 2015. The topic for today's weekly education session is market risk, and it's probably just in time too, given what the market's been doing over the course of the last month or so. So an opportune time to reflect on that and make sure that we've got our head completely around market risk and how we measure it and how we deal with it in real time. So let's get underway. Firstly, our disclaimer: the content of this presentation or any other Elite Traders Club material does not constitute a recommendation, nor does it take into account your investment objective, financial situation, nor particular needs. So please, before making any decisions based upon the general advice contained in any Elite Wealth presentation, please consider whether it is appropriate in light of your financial circumstances or seek further advice on its appropriateness. The agenda for today is to discuss market risk, and by that I mean market risk as it relates to our medium-term investing or trading. So we'll be having a look at our two respective benchmarks, the ASX 200 and the S&P 1500, as our benchmarks. So we're looking at those and on the basis of what they're doing, ascertaining what the overall market is, what level of risk we're at, and what impact that's going to have on our portfolio. Importantly, we need to understand the concept of market risk multipliers. So we'll be going through and having a look at some examples of this to make sure that we're understanding of the change in market conditions, what it means for our portfolio, and what it means for us in terms of active management, active portfolio management, active risk management. And then we'll have a summary at the end. Right, capital management. It's extremely important that we focus on capital management, protection of capital, the number one priority really in our investing and our trading, because if we do a poor job of this, then we end up losing a lot more than we need necessarily do. And the outcome of that, obviously, if we lose more than we want to, it makes getting that money back even more difficult. So the old example, if we lose 50% of our capital, which some people did, during the GFC, they've got to turn what they've got left. They've got to create 100% profit on what they've got left just to get back to break even. So we really need to have our focus on protection of capital. And one very simple way to outperform the markets is just not to participate in bear markets. That's a lot easier said than done. But certainly it's a lot easier to practice if you've got some metrics that help you to decide when we're entering higher risk markets. And that's what our benchmarking model is based on. So you would all know that the main indicator that we use to determine market risk is a stochastic. So the stochastic is just an oscillating indicator that moves between basically 0 and 100 on a scale. And what we've done is chosen to divide that scale up into basically 5 equal sections. And depending on where that oscillator, the stochastic, is placed between those sections, it will determine a level of risk in the market. So when the oscillator, the stochastic, is above 80 but below 100, it represents a low market risk. When the oscillator starts to dip down below 80 and moves between 80 and 60, we then classify the change in market conditions as a moderate market rating. Then should the market deteriorate further, then that stochastic is going to be dragged down through the price action into the range between 40 and 60. So that represents a high market risk, and it's generally the observation that once market risk conditions get down to the high level, looking on the stochastic there between that 40 and 60, is that the market has certainly a greater propensity to slide away to the downside at a fairly quick rate of knots. So it is certainly a big flashing light, as is any change in market risk. But certainly once we get down to that sort of 60, between 60 and 40 level, certainly flashing lights, bells ringing, and really, you owe it to yourself to pay a lot of attention to what's happening in your portfolio, and perhaps reducing some of your exposure. And that's what our benchmarking model helps us to do in any case. Then as we dip down into further and further risk, between 20 and 40, we're obviously anything very high, and then anything below 20, we're in extreme. And extreme conditions we've been in a few times since the GFC, so not just the GFC, but more recently we're at some extreme levels as well. So what we might do is go and have a look and see how this pans out on Beyond Chart. So what all this actually means. Let's give it a context. So you'll see on here I've brought up the S&P 1500, our benchmark for our US portfolio. So comprising of a mixture of 1,500 stocks, including the top 500, some smaller mid caps in there as well. So what we're seeing here down below is our stochastic, which oscillates a bit like a worm, up and down. Now whenever this oscillator is above 80, or between 80 and 100, we're in a low risk environment. And the nice thing about this overlay is that any time that the oscillator moves up above or down below the set lines, the set sections, it gives us a change in market reading. So what I'll do is I'll just zoom in there a little bit and see that as the stochastic, once it's down below 80, you'll see that our market risk rating, it's a little bit difficult to see there because we've got a black candle, but the market risk rating changed from being low risk, where the stochastic was above 80. When it went below 80, the market risk rating changed. So it went from low risk into moderate risk. Then as the stochastic moved along and price action eventually dragged the stochastic back up, the market risk rating changes once again. So this time we're going from a moderate risk market, strong price action, stochastic being pulled up, and we go into a low risk market. If we just go back over time and just make some observations about the stochastic and the performance of the market. Again, you'll see a period where we're in low risk market profile, and I'll go through in a moment and explain these market risk multipliers, but just for the time being, understanding what the stochastic is doing. The price action over a period of time, remember that all indicators other than your price action are delayed. The most concurrent price action that you have is actually the candles themselves. So as the trend or the market starts to move down and dragging our stochastic down, our market risk rating goes from 100% low risk down into moderate risk market. Then as the stochastic dips down even further, now we get down towards the 60 level here, we end up in high market risk. Okay, so high market risk, big flashing light from that point of view, because as I said, the observation can clearly be made that when we get down to this sort of level, that the market can drop away fairly quickly and quite significantly. On this particular occasion, no sooner did we hit the high risk market, it did go down a little bit further into very high risk before turning around and rebounding quite strongly. So this is one of those occasions when the market has collapsed quite quickly, had a big sharp recovery, so what we would call a V-shaped recovery. And from that point of view, obviously the strength of the recovery dragging the stochastic back up out of this very high market risk zone, then moving up into high risk, so back between 40 and 60, getting above between 60 and 80, moving into moderate risk, and then back up against past 80, and we're moving into low risk again once more. So that was back in October time of last year. If we perhaps just sort of zoom out a little bit and have a look at the impact and how the indicator works at various levels. So if we go back to some of the really significant points in market history, if you like, and like your GFC, you remember the Eurozone crisis in middle of 2011, where we had the whole Eurozone, Portugal, Ireland, Italy, Greece, and Spain in all sorts of trouble. And one would suggest that there's still a certain amount of trouble over there with Greece trying to repay their debts at the moment. But what this market risk indicator did for us, and you'll see the examples here, as market risk deteriorated and we got down towards our very high or high market risk, down towards 60, as I said, the propensity for bad things to happen accelerates, if you like. Now, on this particular occasion, we got down to that particular level. We're being very mindful of what we were doing with our portfolio management. and the market managed to pull its way out and move to the upside again. Then, over a period of time, market conditions started to deteriorate, and we got down below this 60 level once more. Now, once we got down below this 60 level, remember we go from a low market risk rating, which is 100, a moderate market risk rating, which is 80%. Once we get down into high market risk, meaning we've moved down below 60 again, you'll see that we had a number of periods where we actually had a bit of a heads up before the market really gave way very rapidly and very quickly. And so this is the advantage of knowing when this stochastic is particularly starting to get down to the 60 level, that it really pays to be quite vigilant with your portfolio. Other examples, again, when we've got down to around about the 60 level, back through 2010, this is the bottom of the GFC basically. In fact, the GFC might even be a little bit before then. Let's scroll out a little bit further. Yes, it is. So we've recovered from the GFC, which is the other referral point. We'll come back to that in a moment. But if we go through, obviously a very volatile time in 2010, market racing up, and then through a series of lower peaks, starting to really drag down this stochastic once more. So by the time it gets down there, we're in high market risk on this particular candle here, which is the one where it goes through the 60 level. Now, from that point on, a lot of volatility and a lot of movement to the downside. So again, that 60 level, just giving you a bit of a heads up that something may be around the corner. Now, not always, and you'll see on this particular case here, where it comes down below 60, that the market turned around and started to move up. But just having that as a bit of a warning sign certainly makes sense. Let's go back to the GFC and have a little bit of a look at what happened during that particular point of time. So the high of our market was in 2000 and 2007, and then eventually over a period of time, the market started to give way. Now, the first time we go below 60 was at the end of 2007. So that was kind of the first heads up that maybe the market was starting to struggle, and this is well before everything really hit the fan. Now, we got down to the 60 level on our stochastic, and you'll see that the market didn't do a hell of a lot more to the downside, a warning sign for us. At that particular point in time, market moved back up a little bit. We nearly made it back up to the 60 level again, but then we started to head down further and further. Now, you would know through your own understanding of price action with these longer term peaks that they're starting to form lower longer term peaks, which, as you would know, is the definition of a longer term downtrend. Now, given that we'd moved below 60 on our stochastic, there's very little time in the next, from this particular point in time here, the end of 2007, where we actually, only for a brief day or two, went back above 60. And that was in May of 2008. This was really before everything hit the fan. We were only up there for a brief second, and then we turned around, and from then onwards, you'll see that price, again, being below 60, price really slipped away, and then once we got into particularly September, October, the market really ripped away, took stacks and stacks of money with it. But using this very simple indicator as a proxy for what's happening in the market, it certainly gives us a big heads up saying there's no way that we should have a whole lot of our money in the market. Okay, now the market's always going to take some of your money when conditions turn. Your job as an investor and as a self-directed investor is to make sure that you don't give too much back. So that's the basic observation with the stochastic there. Exactly the same sort of thing happened in the Australian market as well. So I'll go back to where we are now. And at this point in time, you'll see that the stochastic, we've just moved from low risk and we're just moving into moderate risk in the US market at the moment. So just the other day, crossing down below the 80 line, and you'll see that we've put in a new print there, MR, meaning moderate risk. We'll go and have a look at that's the wrong market, that's the German market. We could use that actually if we were interested in investing in the German market and it was going to be our benchmark index. then absolutely we could use exactly the same market risk parameters for the DAX. So in the Australian market, you'll see from the beginning of the year, we did put on a pretty close to 10% from the beginning of the year, and as a result, really strong price action, dragging this stochastic up from what was towards the end of the year. We were in very much extreme territory, and it was looking like, well, 2015 is not going to be much of a year. Really strong price action managed to pull it back up, and we got back into low risk market territory. Just recently, you'll see that we fell out of a sideways range, came down quite quickly, and as a result, a couple of big candles pulling this indicator down into moderate market risk territory. So we dipped down below 80. Subsequently, price action not being strong enough to drag this up above the 80 level, and the last week really being just a succession of downward days, dragging that indicator now down to below the 60 level. So again, remembering what can happen once we get down to the 60 level is that the market can drop away quite quickly. So from that point of view, we need to then think about, well, how do we manage our portfolio on the basis of this little worm, the stochastic? How do we manage it in relation to different levels of market risk and different levels of value at risk that we will have in our portfolio? So let's just go back to our PowerPoint for the moment. All right, so there's our market risk rating. We know that we've got low, moderate, high, very high, and extreme. So what we need to do is we need to think about our value at risk across our portfolio. So assuming that in your trading plan that you have a maximum allowable drawdown of 15%, which is pretty standard type of profile amongst ETC members, then it means that in a low risk market environment, you are allowed to have 15% of your capital exposed as value at risk in the market under low market risk conditions. Now, when that set of conditions changes and it deteriorates into a moderate risk market, then you are only allowed to apply 80% of your maximum value at risk. So that means you are only now allowed to expose 80% of your 15%, which gives you a net figure of 12% value at risk. So as an example, if you had $100,000 in your portfolio that you were investing under a low market risk condition, then you would be allowed to have $15,000 blowing in the wind, if you like, in the market as value at risk. Should those market conditions deteriorate, then you will need to cut that back by 80%. So 80% of your 15,000 is going to be 12%. 12% of your 100,000 is $12,000. Then as market conditions deteriorate again and go down into high, now remember high is when we move below 60, and you'll see that the market risk multiplier there moves from 80 down to 40, so it's half. And one of the reasons for that is that once we get down into that 60, below that 60 level, is again that the market can drop away very quickly. So better to act quickly in terms of managing your portfolio rather than dilly-dallying and waiting for the market to do what it's going to do. Let's be prepared for it just in case. Then obviously as market conditions deteriorate further, so from a high risk rating into a very high risk, we use a market risk multiplier of 20%, then extreme, we use a market risk multiplier of 10%. So we've talked a lot about percentages there. Let's put some dollar values on it. So assuming that you had a portfolio, as an example, of $200,000, then under a low market risk condition, you'd be allowed to use 100% of your maximum allowable drawdown. So in this case, 15% of your capital you would be allowed to use. So 15% of $200,000 is $30,000. Now that $30,000 value at risk might be across any number of trades. So it doesn't have anything to do with the number of trades, it's just the total amount of capital that you've got at risk in the market. Okay. Now as market conditions deteriorate and we move into a moderate market risk condition, therefore it means we need to apply an 80% market risk multiplier. So in this particular example, 80% of our 15% or 80% of what was 30,000 that we were allowed to use is now 24,000. So the way that you keep an eye on this amount of value at risk across your portfolio, one way to do it is to use the trade journal. So if you don't have a copy of the trade journal, then get in contact with us and we'll show you how to set that up and how you can measure it, measure the value at risk across your portfolio. It is certainly an important concept to get on top of to make sure that you're doing it properly. Then as conditions deteriorate, going down into a high market risk, which is where we are at the moment, and then we're using a 40% market risk multiplier. So 40% of our 15% is actually a net 6%. So of your $200,000, you'd only have $12,000 exposed as risk in the market. And then you can see the conditions change very high. We get down to $10,000 value at risk, and even in extreme conditions, we still have some capital at risk in the market. And the reason that we do that is, should the market turn around and start recovering, that we still benefit from that pickup in market conditions, even though it's applied to a smaller amount of our capital. So that's the benchmarking model, and the way that we can use it to preserve our capital, to make sure that we don't participate in those significant bear markets, and they're the ones that take portfolios a long time to recover. So that's a bit of a wrap up from there. Have we got any questions today about market risk in terms of medium term? Any questions from the crew out there today? It's okay if you don't. If you do happen to think of one later on, certainly get in contact with us and we'll talk through the finer points of capital management. One question that I do sometimes get asked, well, if I want to reduce my exposure, how do I do it? Which trades do I get rid of? And certainly one way to do it, if you're making profits and things like that along the way, one thing that you can consider doing is just selling down portions of your portfolio. So it doesn't mean getting out of all your trades, but certainly selling portions of it helps to reduce the value at risk across your portfolio. And therefore, if the market does happen to deteriorate at an increasing rate, at least you're preserving some of that along the way. If the market does happen to turn around and move back up, then you've got the benefit of still being in there to a certain extent, but you're really looking to see whether or not the market can do the right thing by you. Kim's asked the question, what about price action to upgrade or downgrade the market risk? Look, it's a good question. I've discussed it with a number of people. The stochastic itself, obviously, as an indicator, it does lag. I certainly don't think there's anything the matter with using price action. Price action is something that we've used in the past on the short-term model, and I think with the medium-term style of trading, certainly using price action on a weekly basis, because we're looking at weekly charts, is something that you might consider, to suggest times when you might like to lighten the load a little bit. I think at the end of the day, with your portfolio management, the aim of the portfolio management tool here is to give clients an indication of the changing nature of markets, as they obviously they're quite dynamic and they can change from low risk to high risk very quickly, and vice versa. That the aim is to keep an eye on your overall portfolio, and certainly price action is a concurrent indicator, and that's certainly something that if you wanted to devise your own particular rules for that, and go back over time and just make sure that you're comfortable with them, because trading is really about being consistent, and if you've got something that you can apply that's easy to apply, then the chances are you're much more likely to be consistent in applying it, and less subjective to change. So certainly something like price action, I don't have a problem with that. It's not something that we're going to use at this point as part of portfolio management or market risk indicators, etc. At this point in time, we'll continue to stick with the stochastics, which we have over the last couple of years. But good question. I like the question a lot. Okay, any other questions? Is it more to keep from, okay, there's a question there from David. Is it more to keep from new trades rather than exiting existing trades? Yeah, good question, David. This is one of the things that you face as a trader. Certainly when market conditions deteriorate, the first thing you want to be thinking about is reducing, obviously, the need to put any more trades on, because the market's telling us we are at an increasing risk. So what we want to do there, it's all about hanging on to the capital that we've got. So we're really certainly not looking for excuses to try and find ways into the market. I think, once you've been around in the markets for a while and you start to pick up little nuances and things along the way, certainly much better to be prepared and keep all that capital fresh, because the market's always going to be there. And really we should be looking for opportunities. This goes for every single trade, doesn't matter what market condition there is, looking for opportunities not to be in the market. Because one of the keys to outperformance is actually keeping your powder dry and not being in markets when they deteriorate to the downside. And this is one thing that fund managers are not very good at, because they have a mandate to be invested and they can only have a certain amount of money in cash. Now, it's not much fun being invested when the market is heading south. So we really want to think about what's the market doing? Is it changing conditions? Keep that very much at the forefront of our minds and look for every excuse under the sun not to put more capital into a worsening situation. Now, we don't know that it's going to end up being worse, but certainly that's what we want to be thinking about. Question there from other David. Is the earliest stochastic indicator a pre-made analysis feature of Beyond Charts? I just have not seen it on BC. No, David, good question. I'll show you. Let's go back into Beyond Charts here. So I assume that you're talking about the indicator down the bottom of the chart here, David. This is actually an overlay, which everybody who uses Beyond Charts has. So if you go down into your overlay section here, you'll have a section here that says Portfolio Management System, Medium Term and Short Term. So we still have them both in there for both timeframes. There's a short term overlay that I can put on, and this is certainly switches around a lot more because price action drags it up and down. We use a different indicator for the short term strategy. But everybody who's on the Elite Traders Club will have these overlays as well. The Portfolio Management System, Medium Term. Again, F9, you should all have this. Just apply it to your chart. And it has the exact same overlay there that I'm showing you on screen. So everybody's got that. But certainly if you didn't have it, you could create it yourself using the metrics that are in your trading plan as well. Good question, David. All right, folks, we've gone for nearly half an hour there. If there's no more questions, certainly Mark's got popped in with a very late one. Is there any value in comparing the medium-term stochastic with the custom MACD or the short-term? Look, they're set up for different time frames. The MACD is basically a momentum type of indicator, and rather than crossing the streams, etc., when you're managing your portfolio, just try and stick to the one particular metric. So in this case, with the medium term, we're sticking with the stochastic. I think the more things you try and apply to your trading and having different or opposing views or another view just makes things a little bit more difficult. So the simpler you can keep your metrics, your indicators, your price action along the way, then the easier it's going to be for you to follow over the long term. Now, by doing that, I'm really talking about becoming proficient at what you're doing over the space of 2, 3, 4 years, and that's the sort of time frame that it generally takes most people to get to the level where they really don't need any further assistance. They know exactly what they're doing. They're really moving well beyond that conscious competence stage. They're really getting into the realms of almost unconscious competence, where you really don't need to be thinking too much about what you're doing as part of your investing. Obviously everyone's still got to, first and foremost, is focusing on capital protection. At the end of the day, we have no say in what the market's going to do, only on how much it's allowed to take from us. And that's why we try and have simple metrics that tell us what the market risk is at any point in time, and then apply our understanding of that to our overall capital. All right, guys, look, if you've got any further questions or anything like that, give either myself, David, or Jeff a call in here in the office, or shoot us an email and we'll give you a call and take you through any questions that you may have. Other than that, hopefully the market's not doing you too much damage at this particular point in time. Certainly having a look across my own individual portfolio, I've had to reduce exposure on a number of stocks at this point in time, only to see a few of them bounce back today. But again, I don't know what's going to happen tomorrow or the next week. That's just part and parcel of being in the markets, and I think it's just something that we have to get used to and used to handling and dealing. But as I said, if you need someone to talk to through that, or you need help with the trade journal in particular, if you think that might assist you with your portfolio management, give us a call. We'll be only too happy to help. All right, good trading, and we'll catch up with you on Monday morning for the weekly analysis session. Thanks, guys.